It is mid-April 2026, and while the US stock market shoots like a rocket from one all-time high to the next, a scenario is unfolding behind the closed doors of the White House and the Fed that leaves the average retail investor completely stunned. You might almost think Donald Trump is really trying everything behind the scenes to trigger a massive recession in the US, only to appear as a great savior later. We are seeing a bizarre disconnect. On the one hand, Wall Street is popping champagne corks and the S&P 500 is unstoppable. But on the other hand, the foundation of the real economy is crumbling at a pace that worries even experienced economists. Why is the job market suddenly collapsing while tech giants report record profits? Are we perhaps already in the middle of a recession without noticing it? Today we are looking at exactly that. We clarify what a recession really means and why the official announcement usually comes too late for your portfolio. We analyze which forces are currently putting pressure on the job market and why certain sectors are already in a recession while others are booming. And we look at what this specifically means for quality stocks like ServiceNow or Micron, and what lessons historical crises hold for investors today. Let us not waste any time, let's go. Let us look directly at the first warning sign that many are currently ignoring completely. If we take a look at the current Atlanta Fed GDP Now forecast, the real-time barometer for US economic growth, we see a massive crash. While we still had growth rates of over 4% at the end of 2025, the model is currently adjusting massively downward for the first quarter of 2026 towards 2.1% or even lower. And now comes the absolutely crazy part. The S&P 500 does not seem to have noticed this at all. It hits one new all-time high after another. Do you remember late March? We sat here and talked about our additional purchases and why many on the stock market will profit from the Iran war. And that is exactly what happened. At the end of March, the market turned, and now we are shooting to new all-time highs. And before we continue, I want to show you briefly why it pays off to stay tuned here. On April 12, we took a close look at Microsoft on this channel with the help of Liberty, and what we said technically back then was crystal clear. The stock sold off exactly into the defined target zone between $362 and $374. That was not a gut feeling and no speculation, but technical analysis based on clear structures. Anyone who followed that knew that an opportunity was emerging right here. Do not buy in blindly, but observe, wait for confirmation and then act. That is exactly the difference between reacting and acting. And you get exactly such analysis for Microsoft, ServiceNow, Micron and many other stocks regularly right here before the rest of the market even acts. So if you do not want to miss any of these assessments and want to learn how it all works, subscribe to the channel now and activate the bell. But let us briefly get to the basics. What does a recession actually mean? Experts speak of a recession when economic output stagnates or shrinks. The simplest definition, the so-called technical recession, says 2 consecutive quarters of negative GDP growth. In the US, this was last the case in 2020 during the pandemic. Since then, officially expansion. But the recession is much more complex than this one metric. Overcrowded warehouses, falling demand, reduced working hours and a cautious investment approach by companies, all this belongs to the big picture. What we are seeing right now is a divided economy. The AI sector is booming. Nvidia and Micron can hardly keep up with deliveries, while retail and classic software providers are under massive pressure. We have sector recessions within a boom market. Anyone who ignores this and blindly buys the index could be caught off guard when the rotation starts. And here is the point that most retail investors do not understand. When the official news comes that we are in a recession, it is usually already too late for your portfolio, or exactly the wrong time to sell. In the US, the National Bureau of Economic Research decides when a recession begins. And these people take their time. A lot of time. Historically speaking, a recession is only announced 6 to 21 months after it actually begins. Look at 2008. The recession began in December 2007, but the NBER only officially confirmed it in December 2008. The market was already almost at the bottom then. Or 1991, when the recession was officially announced, the market was already back at new all-time highs. Anyone who waits for the expert permission to invest misses out on the best prices of their life. The stock market trades the future, not the past. The stock market usually recovers when the mood is at its worst and the official data is still glowing deep red. That is exactly what we saw at the beginning of 2026. People got emotional, surrendered, and thought that this is the time everything is different. The statistics no longer work. And what happened? The market turned upwards. In February 2026, the US surprisingly lost 92,000 jobs, a result that completely contradicts the narrative of a booming America. Trump's tariff policy puts a massive pressure on supply chains. Costs for companies rise, interest rates remain high, and what do companies do in this environment? They save on staff. Particularly striking, 88% of the previous job growth under Trump comes from the government sector or state-related areas like healthcare. The private sector, the actual engine of the economy, is stuttering massively. The unemployment rate for native-born Americans has risen to 4.7%, the exact opposite of what was promised. One sector that is suffering particularly under this job market pressure is enterprise software. The core problem lies in the business model. Seat-based pricing means companies like ServiceNow charge an employee license. If companies cut jobs or freeze hiring, the growth potential automatically drops. That is the structural reason for the current weakness in this sector, not poor software quality and not AI. The decisive shift is happening right now, however. ServiceNow is switching to consumption-based pricing. In the future, the company will make money when AI agents complete tasks, regardless of the number of employees. This is a fundamental transformation of the business model that the markets had not yet priced in. If you want to learn more about this, I have linked our latest video on software stocks in the description if you're particularly interested in that topic. Anyone who wants to understand why panic would be exactly the wrong thing right now should, in my opinion, look at Micron. In 2024 and 2025, the stock fell enormously while the S&P 500 rose. Today, in 2026, the price has more than quadrupled. Or Starbucks in 2008, down 60% from its peak. Anyone who bought in at minus 30 or 40% had to endure massive paper losses again. But anyone who stayed is now sitting on over 1000% return plus dividends. One learning you should draw from such situations is that there is no such thing as perfect timing. What counts is time in the market, not timing the market. Quality companies with a strong moat, stable cash flows, and structural growth survive recessions and deliver disproportionate returns afterwards. Yes, certain sectors in the US are already in a recession. The job market is under pressure, political uncertainty is high, but markets act counter-cyclically. Bull markets that reach a third year almost always go into a fourth year, statistically speaking. The upward trend is intact. The strategy is to buy quality when it's under pressure and not to react to headlines but to data. Crises are not endpoints but opportunities for all of you who are brave and do not sell in panic. If you like this video, then check out one of these two videos. In one we analyze Novo Nordisk, and the other one we show you which software stocks we are bullish on. Stay invested until the next video. Bye!